This is Adithya from PGP 1719 batch IMTC. Bank fraud. A pressing concern for the banking regulator is the increased number of fraudulent transactions at Indian banks. What's adding to the concerns is that banks often seem reluctant to report these cases. Almost all corporate loan related fraud cases get seasoned for 2 to 3 years as NPAs before them as reported as fraud. In the last 5 years, the volume of bank fraud has increased by 19.6% to 5064 cases. Asset quality. The highest risk to Indian bank is the rise in bad loans. The slowdown in the economy in the last few years led to a rise in bad loans or non-performing assets. These are loans which are not repaid back by the borrower. They are thus a loss for the bank. Net NPAs amount to only 2.36% of the total loans in the banking system. This may not seem like an alarming figure. However, it does not take into account restructured assets. When a borrower is unable to pay back and the bank makes the loan more flexible to be paid back over a longer period of time. Restructured assets put pressure on a bank's profitability. Together, such assets account to 10.9% of the total loans in the system, and these are just loans which are identified as stressed assets. 37% of the total debt in India is at risk, yet banks have capacity to absorb only 7.9% loss. So if these debts turn bad too, banks will face major losses. Capital adequacy. One way a bank tries to ensure it is protected from bad loans is by setting aside money as a provision. This money cannot be used for any other purposes including lending. As a result, banks have lower capital available to use for its various operations. The capital adequacy ratio measures how much capital a bank has. When this falls, the bank has to borrow money or use depositors' money to lend. This money, however, is riskier and costlier than the bank's own capital. For example, a depositor can withdraw his/her money anytime they want. So a fall in CAR, often called as CRAR, is worrisome. In the last few years, CRAR has declined steadily for Indian banks, especially for public sector banks. Moreover, banks are not able to raise money easily, especially public sector banks which have higher number of bad loans. If the banks do not shore up their capital soon, some could fail to meet the minimum capital requirements set by the RBI. In such a case, they could face severe issues. Unhedged Forex exposure. The wild gyrations in the Forex market have the potential to inflict significant stress in the books of Indian companies who have heavily borrowed abroad. This stress can affect their ability to pay back debt to Indian banks. As a result, the RBI wants banks to ensure companies they lend to do not expose themselves to unnecessary debt in dollars. Employee and technology. Public sector banks are seeing more employees retire these days. So younger employees are replacing the elder, more experienced employees. This, however, happens at junior levels. As a result, there would be a virtual vacuum at the middle and senior level. The absence of middle management could lead to adverse impacts on banks' decision-making process, as this segment of officers played a critical role in translating the top management strategy into workable action plans. Moreover, banks, especially government-owned banks, need to embrace technology to offer better products. This will also help make banks more efficient. Balance sheet management. In the past few years, many banks have tried to delay setting aside money as provisions. One reason for this is that a bank's chief executive has a short tenure, during which time he or she wants to post higher net profits and cheer investors. It must be appreciated that CEOs, CMDs would come and go, but the institutions are perpetual entities. The only thing which can perpetuate their existence is a stronger and healthier balance sheet. Deferring provisioning is harmful in the long term. It reduces the bank's ability to withstand financial pressures. This is even more problematic considering the poor capital adequacy in Indian banks. In fact, investors would be more happy if the management addresses and sorts out problem rather than posting higher net profits that cannot be sustained in the long run. Cyber threats. An estimated 95% of transactions in India are paid for in cash. But with the growing penetration of computers and smartphones and increasing access to the internet, Indians are taking to the digital channels for their banking needs. Cybercrime is becoming a greater threat as a result. The FSR labeled cyber attacks as a high-risk zone for India's banking sector. The RBI classifies bank fraud as transactions involving any cheating, negligence, misappropriation of funds, or forged documents. Not only simple attacks using phishing, wishing, and social engineering, but also increasingly audacious attacks by organized gangs with or without banking by state players has come to light, the RBI said. The clamor to secure India's banking system increased following a massive data breach of 3.2 million debit and credit cards last year, one of the biggest attacks in the country. Another red flag was the recent global ransomware attack that affected the computer systems of governments and several companies in various countries, including India. The RBI recommended that banks invest in preventive software and frequently assess the risks at hand, not just for in-house operations, but also for the external vendors that the lenders employ. Thank you.